William Bernstein's If You Can, How Millennials Can Get Rich Slowly is a concise guide that provides practical, no-nonsense advice for building wealth over a lifetime. The Path to Financial Freedom. Would you believe that a 7-year-old could understand a simple investment strategy capable of outperforming most finance professionals? Bernstein argues that this is entirely possible with a disciplined approach. The journey begins with a single rule: save 15% of your income, starting at age 25, and allocate it evenly across 3 types of mutual funds: a U.S. total stock market index fund, an international total stock market index fund, a U.S. total bond market index fund. Rebalancing these funds annually ensures a balanced portfolio. While the math is straightforward, Bernstein acknowledges that sticking to this plan is the true challenge, akin to following a diet. Hurdle number 1: overcoming spending habits. Even if you can invest like Warren Buffett, if you can't save, you'll stay poor, Bernstein warns. Saving is critical but difficult in a world of endless consumer temptations. Millennials often overspend on the latest gadgets, luxurious apartments, and unnecessary subscriptions. These expenditures add up, jeopardizing their financial future. Example: Bernstein illustrates this by showing that saving $625 monthly on a $50,000 salary requires sacrifices, such as sharing a living space or cutting back on dining out. He emphasizes the long-term trade-off: live modestly now to avoid hardship in retirement. Hurdle number 2: understanding finance. Basics investing isn't rocket science, but some financial literacy is essential. Bernstein simplifies key concepts: stocks versus bonds. Stocks represent ownership and higher risk, while bonds are loans to companies or governments with lower returns. Stocks typically yield higher returns over decades, but they're also more volatile. Risk versus return. High returns come with high risks. For instance, stocks lost 90% of their value during the Great Depression and nearly 60% during the 2008 financial crisis. Successful investors accept and plan for these downturns. Key takeaway: avoid trying to beat the market or time it. Research shows even professional fund managers struggle to do so consistently. Instead, invest in low-cost index funds and stick with them for the long haul. Hurdle 3: learning financial history. Bernstein stresses the importance of understanding market history to navigate its emotional roller coaster. The stock market's patterns often repeat, albeit in slightly different forms. He recounts moments of irrational exuberance and despair. Example: during the 1990s tech boom, day traders believed they could get rich overnight. Similarly, the 2008 housing bubble saw many investors speculating wildly. Both ended in financial disaster for many. Lesson: when everyone is euphoric about an investment, it's likely overpriced. Conversely, the best opportunities often arise during economic downturns when fear dominates the market. Bernstein advises maintaining a disciplined fixed allocation to stocks and bonds, buying more stocks when prices drop and selling some when they rise too high. Hurdle number 4: conquering behavioral biases. We have met the enemy, and he is us. Bernstein quotes, highlighting how human psychology can sabotage financial success. Our evolutionary instincts favor short-term survival over long-term planning, leading to behaviors like panic selling during market crashes or overconfidence during booms. Example: Bernstein shares the story of a couple who sold their investments during the 2008 crash, only to buy back in at market highs years later. This buy high, sell low pattern is common among inexperienced investors. Solution: recognize and resist these biases. Bernstein recommends reading Jason Zweig's Your Money and Your Brain to understand how emotions influence financial decisions and learn strategies to stay the course. Hurdle number 5. Avoiding the financial industry's pitfalls. The financial services industry, Bernstein warns, often prioritizes its profits over clients' interests. Brokers and advisors may recommend high-fee products that benefit them more than investors. He strongly advises avoiding high-fee mutual funds. Index funds like those offered by Vanguard have minimal fees, maximizing investor returns. Steering clear of stock-picking advice. Most advisors and newsletters offer little more than speculation. Bernstein's rule is simple. Treat most of the financial industry as an urban combat zone and stick to low-cost index funds. The nuts and bolts of saving and investing. Once you've conquered the psychological and practical hurdles, it's time to implement your plan. Pay off high-interest debt first. Prioritize eliminating credit card and car loans. Contribute just enough to your 401k to get your employer's match during this phase. Build an emergency fund. Save 6 months' worth of living expenses in liquid, low-risk accounts like T-bills or money market funds. Maximize retirement savings. Contribute to tax-advantaged accounts like a 401k or IRA. If eligible, choose a Roth IRA for its tax-free growth potential. Allocate wisely. Divide contributions equally between U.S. stocks, international stocks, and bonds. Rebalance annually. Example, funds. Vanguard's Total Stock Market Index, Total International Stock Index, and Total Bond Market Index are excellent low-cost options. The final lesson, consistency, is key. Bernstein concludes with a reminder that wealth building is a marathon, not a sprint. Small, consistent efforts compound over decades. By saving diligently, investing wisely, and avoiding common pitfalls, millennials can achieve financial independence and retire comfortably. In summary, if you can serve as a roadmap for anyone willing to take control of their financial future, through simple strategies, historical insights, and practical advice, Bernstein equips readers with the tools to overcome life's financial hurdles and build lasting wealth. Stick to the plan, and the rewards will follow.
Thank you for listening to this audiobook by One Chapter Closer. Congratulations on being one book closer to your reading goals. Don't forget to check out our channel for more specially curated audiobooks. If you enjoyed this, please like, share, and subscribe to stay updated on new releases. See you in the next book.